Hi everyone, thank you for joining us in the Upside Down series brought to you by NN Investment Partners. We are very excited to have you and to see so many registrations for today's event. Now, if you joined us late September, you'll remember that we reflected on the impact of COVID-19 on corporates with Mark Randolph, co-founder of Netflix, and Maarten Geerdink, NNIP's head of European equities. Today we're back to tackle COVID's impact from a government angle. My name is Marije Groen and I'm delighted to be joined today by Mariana Mazzucato, professor in the economics of innovation and public value at UCL, who will join us from the UK, London to be precise, and by Marco Willner, NNIP's head of investment strategy multi-asset, who is here with me in the studio in Amsterdam. Marco, welcome. Good to have you.
Thank you for having me.
Thanks so much for being here. Now, what do we have in store for you in the next hour and a half? We'll start off with Mark Randolph, who will briefly share his reflections from the last event. After that, we'll transition to the keynotes about the topic of today by both Mariana and by Marco. And then we'll come back for the interactive part of this webinar with a fireside chat between both speakers and a Q&A that allows you to ask your questions. The team here is ready to receive your questions already right now, so just send them in as they come to mind by using the chat function. And also don't forget to let us know who your question is for by using @Mariana for a question for Mariana, @Marco, or maybe you have a question for both. Now, just as a quick reminder, let's explain to you how the platform works. So where we are now is the main stage. This is where the speakers will be hosting their keynotes, where we will have the fireside chat and also the Q&A. Now, on the right, you see a networking button, and at the end of the event, from 2:35 to 3:10 p.m. Central European Time, this area will be open for 30 minutes to give you the opportunity to network with other event participants. You will automatically be matched with someone else. Now, what's more, please look out for any pinned messages on top of the chat for announcements coming from our crew. And if, in any case, you are experiencing any technical issues, please send us a message in the chat using @NNIP, and the team here will try to respond to you as quickly as possible. Let's now not wait any longer and watch the video message from Mark Randolph.
Hello again, this is Mark Randolph. And thank you once again to NN Investment Partners for inviting me to speak at their Upside Down series. And thank you, Martin, for a great conversation. As I've had a chance to reflect back on the event, it struck me just how important it's become for everyone to think like a startup. The need to reinvent the future is no longer just the domain of Silicon Valley startups. Now every company, whether they're large or small, brand new or well-established, the front runner or the competitor, they all have to move quickly, adapt nimbly, take risks, and be prepared for whatever the future brings. It's a future that continues to be opaque, and I'm so excited to see what the future brings us. But I'm equally excited to hand over to the next guest speaker, leading economist Mariana Mazzucato. I hope you'll enjoy her keynote and the lively discussion that will certainly follow.
That bumper came a little too late, but no worries. We thank Mark for sharing his thoughts with us. And like he said, it is now time to welcome today's keynote speaker, Mariana Mazzucato. Mariana, like I said, is professor in the economics of innovation and public value at University College London. She was named one of the 3 most important thinkers about innovation by the New Republic and one of the 25 leaders shaping the future of capitalism by Wired. Her highly acclaimed book, The Entrepreneurial State, from 2013, investigates the critical role the state plays in driving growth. Her other book, The Value of Everything, from 2018, looks at how value creation needs to be rewarded over value extraction. Let's watch Mariana's keynote.
Hello,
I am Mariana Mazzucato. I am the founder and director of the Institute for Innovation and Public Purpose at University College London. And I'm thrilled to speak to you today about recent thinking that I've been advocating, framing on how to actually direct our economies to achieve big goals, as opposed to obsessing about the rate of growth. Let me just quickly share the screen here. This is always the tricky bit. And put it on PowerPoint. There we go. Okay, so what I want to argue is that we absolutely have to go to first principles. We need to rethink where does value come from? Who creates it? How can we redirect it? This is very important for actually confronting some of the biggest challenges that we have today. Fortunately, the conversation about redirecting growth and not just obsessing about its rate is out there. Since 2015, we have the Sustainable Development Goals. These are goals that have been agreed on by nations worldwide, and they're bold. They have to do with hunger, with cleaning our oceans, with reducing inequality, with getting gender parity, and ultimately, very important to actually have a planet that we can all live on and share our resources instead of fueling war between us in terms of who gets what. And this has been very central also to the conversations about the Green Deal, the green transition, which, you know, before the health pandemic was very much at the center of many different regions and how they were thinking about redirecting growth. We also have the return of industrial strategy in many countries, rethinking industry, manufacturing, and how that itself has to be part of a green transition. So basically, there's no lack of will to go to a better economy. The question is, do we know how to get there? Do we have the tools on the ground? And it's curious that both in the business community and within state structures, there is a call for change. My next two slides here just show evidence that, you know, in the last couple of years, there's been a very explicit discussion within the corporate world about the need to bring purpose and stakeholder value to the center of how businesses operate. So this was a letter written by Larry Fink, the CEO of BlackRock, about the need for more purpose, for long-termism, for investing in people and communities. And a similar point was made around stakeholder value by the Business Roundtable, which just 1 or 2 years after that, actually 1 year after that, in the summer of 2019, they published a letter in the New York Times about the need, again, for long-termism and really thinking about all the different stakeholders that surround a company. So, you know, this must be part of the change, must be part of the change that will actually get us towards an economy that's more inclusive and sustainable. And yet, unfortunately, we're not seeing as much change in the business community as would be required if we're going to really meet those targets that I had up there in the beginning. And part of this reason, I believe, is that the state itself, you know, has really been focused too much on thinking about its role as correcting problems when they arise, right? So this idea that the state is for fixing market failures. This is how economists talk about the role of policy. So, you know, do we actually then need not just to bring purpose at the center of corporate governance, but also think about purpose at the center of the policymaking process and hence of the public-private relationship? And I would argue, yes, you can tell from how I'm saying that. And in order to steer change, you know, if we really are going to redirect growth, if we're going to meet the 17 Sustainable Development Goals, if we're going to have a green transition founded on a Green New Deal, we need to also be very clear on what the underlying problems are in our economy that require that change. There's no point of talking about change for change's sake. So what I want to do just in the next 5 minutes before I propose an alternative view and my own thinking of how we can actually bring purpose to the center of the global economy is just to be clear on what the problems are and how bad they are. I'm going to go through them quickly, but it's just to make sure we're all on the same page. So firstly, we have a real problem in the financial sector. And you know, different people have been writing about this. This is data from the Bank of England, just showing how much finance itself has really outpaced in the end the growth of the real economy. And if you look at underlying this, why that is, what you see, for example, in countries like the UK, that, you know, one of the reasons is that a lot of the finance itself has actually been going to other parts of the financial sector. So specifically finance, insurance, and real estate, FIRE. And this is data here again for the UK domestic bank lending. But what you see again in countries like the UK and the US is that what this has then meant is that the degree of credit going to areas like mortgages as opposed to non-mortgage lending, which might be, for example, finance to small, medium enterprises or to infrastructure, has been rising. And this is not independent of then what we see in terms of housing price booms, real estate booms, which are absolutely caused by that oversupply of credit to actually buy, homes, often by people who don't necessarily have the underlying income to then support those purchases. So you end up, like in the UK, with a very high private debt to disposable income ratio, currently back to the level it was just before the financial crisis. And it would be great if all the problem was just in the financial sector. In fact, we also have a big problem in industry. Just 1 second, there was too much sun before. I'm going to open up the shade here to let light bless us without having to start the video. I had to shut the shades before because I had too much sun in my face, and now all of a sudden I have too little. I hope you don't mind this. This is the problem when you do recordings. Right, so it would be great if all the problem was just in the financial sector, but unfortunately we also have financialization of industry itself. And you can see this really by the amount of share buybacks, for example, that have been used in recent years. Companies spending a lot of their net income just buying back their own shares to boost share prices, stock options, and executive pay. And this data here is from 2008 to 2017, but even more recently, I couldn't get a good graph for this, but from 2010, 2020, the pattern has even increased even more. So over $4 trillion have been used by Fortune 500 companies just to buy back their own shares. And so this lack of reinvestment back into the economy that we already saw before with the financial sector is just as true, actually, unfortunately, for the industrial sector. And you see this then, don't forget GDP can be divided in different ways. And the part of it that is composed of business investment, right, consumption, investment, government spending, and net exports, the I part, business investment, has actually been falling in many countries. And you see this in the US, and this is not, unrelated to how much money is being kind of extracted out of the system through these financialized practices. And this also, of course, affects inequality. Workers will benefit when they are working in companies where the funds are reinvested back into the long run growth of the companies, but also in areas like research and development and human capital formation itself. Skills are a result of that. So yes, we also have other problems like the weakness of labor unions, which negotiate labor share. The labor share, by the way, is at the lowest it's ever been in terms of the share of profits and wages and GDP. But this is, again, an outcome also of the degree to which value is extracted out of the economy. We also have, obviously, a huge climate problem. We already saw that in terms of why the Green Deal is so important in terms of discussion. But the IPCC report has woken us all up to the fact that we simply don't have that much time. We need to get our acts together. In their famous report a couple of years ago, they said we just have about 11 years left. So now 9 years left if we're going to keep global warming at a level that's below the point where we actually have a point of no return, basically. And yet current investment in green energy is only 20% of what it should be. But also, instead of just thinking about green energy, it's really about a green transformation of all sectors, from steel to other bits of manufacturing. And unfortunately, I've just seen data actually yesterday that a lot of the COVID recovery funds are still going mainly to a large extent to fossil fuel generated production structures. So, and then we have a fifth problem. I said I was gonna, focus on 5 big problems in the beginning, and this is the state. The state itself has sort of bought into this idea that it's there just to fix market failures. And this idea that, we have the bureaucrats on one side and the creative entrepreneurs on the other is really just a myth. It's a myth of where we think value comes from. It has generated a kind of cartoon image of what we think we actually need from the state itself. And so rethinking the bureaucracy is very much important. I'll come back to that in a minute. So what I want to do is really look at some insights that I've been putting forwards on different publications, the entrepreneurial state. I'll begin with that last point. What is the state for? but also underlying all this, how do we create value between business, between the state, civil society organizations, including trade unions, and lastly, some recent work that I've done with global policymakers in bringing kind of a moonshot purpose lens, a mission-oriented lens to the center of how we think about the global economy. And so I will go through big insights that come out of these books that I hope then allow us to confront those 5 big problems, but also more, generally, that allow us to rethink about the direction of growth, how to actually achieve growth that is different, that is more inclusive and more sustainable, how to achieve our sustainable development goals, given that we've actually signed up to them. So rate of growth, value creation, direction of growth, and inclusive growth, these are all themes that I'm going to be bringing in to the next 20 minutes of my talk to you this morning. So firstly, this book that I wrote back in 2013 was really trying to debunk our understanding of where growth comes from. We all know that innovation is absolutely central to global capitalism. We wouldn't have, decades of growth. We wouldn't have had the internet revolution without innovation. But where does that innovation actually come from? And, this idea that it mainly comes from the private sector and the state is there just to fix market failures along the way, as I've already mentioned, is part of the problem. In fact, we would not have had any of the large general purpose technologies, which are technological changes which have affected production, distribution, and consumption, had we not actually had really active, strategic, value-creating machinery in both the public and the private sectors. And yet we don't really know how to talk about that. We continue to think of that cartoon image of the state there just as kind of fixing problems, regulating, administering, facilitating, and enabling. And yet all these different changes here could not have happened without state investment. And in my book, I looked at all the technologies that make our smart products smart and not stupid, like my iPhone here. And in fact, the internet, GPS, Siri, touchscreen display would not have come about without active, strategic, long-term, patient state investments. And these weren't investments that flew down from helicopters, public money thrown down. It was actually from very bold public institutions like DARPA, which invested in the internet. The Navy itself invested into GPS. And these examples that I've just given were actually outcomes of organizations in the public sector that were problem-oriented. The internet didn't come about by thinking about the internet. It came about as a solution to a problem, getting the satellites to communicate. So, thinking about these problem-based organizations, this is why I already back then in 2013 got very interested in better understanding what it means at the organizational level, not just the private sector, but also the public sector, to be problem-focused, outcomes-oriented. And in fact, many of these organizations like NASA, which got us to the moon and back in a generation, as Kennedy set out back in the early 1960s, and DARPA, which I already mentioned, invested in the internet, but also public banks in the world, like the KfW, the German Public Bank, or in the US, the National Institutes of Health. They've actually been explicitly within their own internal organizations about shaping and creating markets. They have missions, and yet we don't understand this in terms of the economy. We don't have, from economic theory, regressions with the dummy variable being, yes or no, was the state actually strategically oriented, or was it just kind of handing out subsidies and guarantees? And so just coming back to this point here, what's really then required is to step back and actually admit that you have all these different value creators in society. In this first book, I focus more on the history of Silicon Valley, to get away from this idea that all the wealth creation happened by garage tinkers and the entrepreneurship community or in venture capital. And so what I then did in a next book, The Value of Everything in 2018, was again to step back and say, well, what does this mean for how we've been thinking about value creation itself? If we don't even get the history, we don't understand the massive amounts of collective state investments that were required to get us investment-led growth, whether it be in Silicon Valley or in places like Denmark today. Denmark is the #1 provider of high-tech green services to the Chinese economy, which is spending 1.7 trillion on greening its economy. We don't understand where that came from, or the investments in China itself, which are today actually making it one of the leaders around green innovation. Or why is it that Germany has been achieving higher productivity levels than Italy, for example, or Portugal and Spain. In Europe, what is the role of, again, public and private actors in determining that? Then it's going to be very hard to steer economies towards better objectives, sustainable development goals, a green transition, if we don't even get the history. And so here in this book, what I did was to step back and say, well, what is this, where have we gone wrong? How do we even understand how value is created in the economy? And I was very interested to find that back in the 1700s and 1800s, in early economic thinking, in the physiocrats who were writing in agricultural periods, in the classical economists who were writing in the Industrial Revolution, they really focused a lot on value. They tried to think, where does value actually come from? And then we're absolutely concerned to make sure that that value got reinvested back into the economy, not extracted out. And you can see here where I'm going, given the emphasis I just put before on value extraction through practices like share buybacks and others. So what the physiocrats did, let me just show you this in a more user-friendly way here. They basically built the first Excel sheet ever, and they focused on farming as the key place where value creation happened, and then we're very concerned with the degree to which that value that was created by the farmers, who they called the productive class, was actually reinvested back in the economy and not extracted out by those who they thought were actually endangering value creation. So the landlords, for example, who they called the sterile class, they were worried if too much of the money went to the landlords and then wasn't reinvested back into making the land more productive. They were also worried about the proprietors, who were the merchants, and the degree to which, again, value could be misused if too much of it was being used just to sell goods and services in the shops, as important as that might be for distribution, but too much being given to the merchants and to the landlords, who then weren't reinvesting back into actually making the land more productive. And this is actually a point that Adam Smith really worried about too in his book, The Wealth of Nations. He focused on industrial labor, given the time he was living through, as the key source of value, and then worried about the degree to which there was reinvestment in actually making productive structures more productive to increase growth and the wealth of nations. And so he really focused on the division of labor itself. This was the famous example of the pin factory, where he looked at the need for actually having a productive division of labor between all the different tasks. So instead of just making one pin a day, you can make thousands of pins a day. But again, there too, also David Ricardo and Karl Marx himself really looked at this kind of objective understanding of where value came from, and worried about how it was being circulated, who's creating what, and where is that value actually going. And one of the problems with what then happened later in neoclassical economics is that all the focus, instead of it being on the objective conditions of production, who's doing what and why, ended up just focusing on the price mechanism itself. Instead of having a theory of value that turned into a theory of price, basically all the theory of, everyone's just maximizing their individual decision-making, businesses maximizing their profits, workers maximizing their choice of leisure versus work, consumers maximizing their utility, and all of these maximizing decisions making our famous supply and demand curves, forming the unique equilibrium price. That approach basically just focused on exchange, individual maximization principles, which then revealed value through prices. And one of the points I've been making is it's actually quite useful to go back to what the classicals and the physiocrats were doing, which is to actually look at production itself. Who's doing what and why? Who's getting what and why? And this would reveal to us that, for example, there's lots of rent in our economy. Rent, not so much in terms of the rent we're paying, for housing, but rent in terms of what Adam Smith worried about, which is rent in terms, again, of value extraction. He actually called rent theft. So the difference between value creation and value extraction. And in fact, today, because we have GDP, which really is just looking at those goods and services that have prices, it means that we're not actually asking ourselves whether those goods and services are actually creating value or extracting it. And just because a particular area is charging something for it, we assume that that is actually value generation and put it into GDP. Again, I can't go into the details of this. This is just something that is very important for us to be reflecting on if we want to steer the economy towards meeting objectives. We have to be asking, are we even looking or asking what is value? In a way that the physiocrats and the classicals used to do, because they had a real lens on production itself. And third, this need to actually bring purpose to the center of how we think about the economy, and the call from the business community itself to do so requires, as I've been saying, a very different way for public and private to interact. And coming back to this point I just made about the classicals and the physiocrats, it needs to give us a lens on what is actually happening with the funds. Where are they going? Or can we actually formulate a different type of public-private partnership where the real emphasis is on reinvestment back into the real economy, not value extracted, but also giving that investment a goal. And so this notion of mission orientation and purpose orientation becomes very relevant. And I wrote a report back in 2018 for the European Commission, which actually made this concept of missions a formal instrument. And the idea was, look at what got us to the moon and back again in one generation. It was actual focus on a problem. And that problem could only be solved by having lots of different public and private actors focused on it. Going to the moon was not just aeronautics, it was also massive amounts of investment in innovation in areas like nutrition, textiles, electronics. The entire software industry actually came out of that moonshot. So the challenge at the time was the Cold War. The mission was the moon landing, lots of different sectors like the ones I just named. And what government did, which was quite brilliant at the time, was to design its levers like procurement, prizes, grants, and loans to really crowd in bottom-up solutions in the business community to actually foster innovation and investment that could get us there. So what I put forward in this report, which, as I said, then actually led to new legislation in the European area, specifically inside the European Commission with this new instrument called missions now, was to say, let's begin with the SDGs. Let's make those our goals today, not the Cold War. And what would it look like if you could really foster public and private reinvestment, not extraction, reinvestment towards those goals? And what does that mean for how we design innovation policy, industrial strategy, procurement? So starting with climate change, for example, big challenge that we have, making it very specific and moonshot, mission-oriented, 100 carbon neutral cities by 2030. Think of all the different sectors that would have to invest and innovate to get there, and all the different bottom-up projects that would be required to stimulate innovation and new solutions to meet that target. Similarly, clean oceans, plastic-free ocean, reduction of 90% of plastics entering the marine environment. That's a very specific goal. You can actually say yes or no, did we achieve it? Lots of different sectors and bottom-up projects to get there. And this becomes very important also for how we frame. As I mentioned in the beginning, there's a return of industrial strategy, but the risk is that that just becomes a list of sectors, right? So how do you have a problem-focused, mission-oriented, purpose-oriented idea of how you actually get all your different sectors together as opposed to making a random list of sectors? So we work very closely in my institute with Theresa May's government in bringing a mission-oriented approach to the UK's industrial strategy, which until then had just been a list of 5 sectors. It was life sciences, aeronautics, automobiles, creative sector, and financial services. And the idea was think of big problems like clean growth, aging, future mobility, and then formulate very concrete missions on how to get there. So for example, on the mobility one, we helped the government and the civil servants we were working with formulate a mission that also had to do with mobility that was sustainable, accessible, safe, healthy, and resilient. And just the fact that we focused on accessibility meant that the kind of bottom-up projects that were then stimulated included projects in the areas of disabilities. But all those different sectors that included transport, design, robotics, energy, financial services, that was a way to get all the different sectors focused together on a public goal, and a goal that of course would require investment, which could absolutely be profit-oriented, but it wasn't just about bringing the private sector into a public goal in order to lead to commercialization. The goal was to really build a public-private partnership that was purpose oriented, and that did require redesigning the tools themselves, redesigning industrial policy, procurement, and so on. And we also work closely with different policy leaders around rethinking finance itself. How can you make finance more purpose-oriented? Not only is there not enough finance, as mentioned in the beginning, going into the real economy, but it's also very impatient. Even venture capital is often exit-driven, wanting to exit in 3 or 5 years through an IPO or buyout. This means that many countries often lack the patient long-term finance that has often been required precisely to come first before the venture capitalists are willing to come in. So in fact, venture capital doesn't often enter in the very early stage. So building a public bank or different types of public funds, becomes important. This is why Israel, for example, had Yozma, which was absolutely central to its own ability to become startup nation. This public fund called Yozma actually provided that patient, long-term, mission-oriented finance that existed before the venture capital community came in. So this work that we did with Scotland was about creating a public bank that was about patient finance, but not about handouts and subsidies to failing companies, but again, to be mission-oriented around the big goals they had, which included, for example, digitalizing public administration and public health. And this does mean that we need to be very clear that that whole talk about purpose and stakeholder capitalism has to also come to the institutions themselves in the public sector. So how do we actually build stakeholder driven banks and not just shareholder driven banks, but also in the private sector itself? I mean, this notion that we need more purpose within companies, we need more purpose within the financial sector. And looking at, for example, how ownership structures, the focus of the financial organizations themselves, their approach to risk, their lending preference, but also the maturity of lending, so short-term versus long-term. All these questions are ones that need really concrete sorting through. They're granular questions that allow us actually to build a different form of a financial sector. And another thing I want to raise just to close off in my last 5 minutes is, once we actually look through these different points I've been making, so the state as an entrepreneur, the state as requiring to, co-create wealth alongside the private sector, that market shaping, not just market fixing approach, the need to rethink value underlying that, really having a proper theory of collective value creation and the need for reinvestment. Third, this notion that reinvestment should be more purpose-oriented and mission-oriented brings us to this final point I want to make, which is how then do you bring all this together also towards a framing for inclusive growth, right? So less inequality, more equity, more justness, more fairness, in a way that is not just about redistribution, but pre-distribution. If you actually believe that we have different value creators in the economy, how do we make sure we get the contracts right in the first place so that we don't then create skewed distribution of income, which has to be picked up by the state, which ends up having to waste a lot of its time just worrying about, again, picking up the mess. And this means actually bringing into the contracts themselves of how public and private and third sector organizations relate one to another, a more inclusive approach. And that can be about making sure, basically that we're not just sharing the risk, but also the rewards. That can happen through equity stakes. I often bring the example of the US government that invested both in Tesla and Solyndra, gave them both a $500 million guaranteed loan, but the taxpayer was asked to bail out Solyndra, not getting any shares of the Tesla success. So there's different conversations now globally about equity stakes, also because of the huge amounts of public money that's going in, of course, for the recovery schemes. There's ways to retain perhaps the golden share of the intellectual property rights. This is something actually that, again, the Yozma Venture Capital Fund did in terms of retaining royalties and some of the investments they made. There can be different conditions attached for public and private relationships, for example, conditions on reinvestment of profits as opposed to value extraction, and so on. And I think this really also is extremely important to rethink pre-distribution ways to achieve inclusive growth today, where we're racing towards, the vaccine, or racing towards trying to get new therapies out there for COVID-19, but we need to govern that process. We need to actually govern the innovation process in such a way that actually helps us get there and get the right kind of innovation. So again, coming back to intellectual property rights, the World Health Organization has been advocating that we make sure we foster collective intelligence. Again, coming back to that collective value creation point I've been making, And so that will determine how you actually govern the patents and the intellectual property rights. Currently, patents are often too upstream, they're too wide, they're too strong, hard to license. But also, I think the COVID moment is one that brings back this notion of getting a good deal, right? We don't just want $2 trillion being thrown into the US economy, or 2 trillion euros here in Europe. We need to make sure that how we structure those funds actually really does build back better. So it's been quite refreshing to see how some countries, like in France, the recovery funds that went to Air France and to Renault were actually conditional on these companies reducing their carbon emissions, or in Denmark, it was conditional on not using tax havens. So again, rethinking this particular moment where the state is absolutely back, putting in a lot of money into the economy to help, put the economic system also back on track and building back better. The only way to do that is if we nest that within the contracts themselves. This is my final slide. I want to thank you, and I really do want to argue that thinking through those 4 big points, right? Rethinking the state as a value creator, rethinking value as collectively created and requiring a reinvestment process. Third, rethinking that value creation process as being reinvested towards big goals and missions. And fourth, achieving equity and inclusive growth in a pre-distribution way. This really matters. This really matters if we actually want to dream of a better future, which those goals that I put up there in the beginning, like the SDGs, are all about. And in order to do that, we need to really care about some of these underlying first principles about value creation, where it comes from, how is it distributed, and what is it all for. So thank you very much for listening to me in these last 30 minutes. I hope you've enjoyed the talk. Thank you.
So that wraps up Mariana Mazzukato's keynote. I hope you enjoyed that. She will be joining us live for the Q&A in just a moment. Meanwhile, let me remind you, it's still not too late to hand in your questions via the chat function. Please do not forget to signal who your question is for Mariana or for Marco, or maybe for both. I'm now going to hand over to Marco, Head of Investment Strategy Multi-Asset at NN Investment Partners. Marco has over 15 years of experience in the European asset management industry, specializing in investment strategy, asset allocation, and quantitative investing. In his message, he will share some of his thoughts on the big themes that investors should be exploring as they look at how governments continue to respond to COVID-19.
The COVID pandemic acts as an accelerator and catalyst for the economy and the society. Let me talk you through our views on how this year might become an accelerator and catalyst for a new political paradigm. Second, which 3 big unknowns governments face in the coming decade. And finally, for which possible futures investors might need to prepare. Isn't it incredible how COVID exposed the effectiveness of governments? It unmasked the failures of various governments to contain the virus and to safeguard the economy. The most pronounced controversies occurred in those countries where populist rules, like the US, United Kingdom, or Brazil. And it triggered a strong response for the opposition and the public. COVID deepened the polarization of society. This goes far beyond the traditional left versus right-wing politics. The divide has been between urban versus rural populations, rich versus poor, capital versus labor, old versus young, services sector versus offline sectors such as the tech industry. Let's have a look at the lessons from past eras. Let's start with the lessons from the globalization, which was taking place from 1919 to arguably 2008. Globalization led to much higher inequality in terms of wealth and income. Globalization also triggered various movements against the establishment. Ultimately, all this resulted into a populist backlash. But what about populism? Again, we learned various lessons. First, fact-based decision-making actually helps. Polarization brought by populists create unrest and rifts in the society. These imbalances in the economy and the society create a case for change. But what comes next? We need solutions for the imbalances. We need an inclusive leadership model, ideally including a wide range of a population. Ultimately, we need a new vision for the future of growth, employment, climate change, and identity. Are we on the verge of a progressive era? And will that be the solution? Let me give you 3 examples for a new possible progressive era. Let's start with the current US elections. Biden operates on a semi-progressive platform. He promises $2 trillion of new investments in infrastructure with a particular focus on Green New Deal. Biden also proposes to double the minimum wage. Finally, the program also includes a rise in taxes, especially for those affecting the super rich. The second example is Europe. This year, the EU member states agreed on a €750 billion recovery package. For the first time, the EU will borrow on the markets to finance expenditures throughout the Union. About 20% of those assets are dedicated to green and digital transition. The third example is New Zealand. Prime Minister Jacinda Ardern and the Labour Party just landed a landslide victory. The government was rewarded for good management of the COVID crisis, amongst others. In a campaign, Ardern pledged to focus on inequality and to raise taxes for the rich. These 3 examples fit into a wider mindset. In the aftermath of the great financial crisis, a new heterodox theory called modern monetary theory became popular among some investors. It completely redefines the role of fiscal and monetary policy. Meanwhile, in the orthodox camp, leading central banks are reconsidering their strategy regarding inflation, in the case of the Fed, or negative rates, in the case of the Bank of England. Even the IMF encourages state to do more debt financing spending. Overall, the zeitgeist is moving in the direction of a progressive mindset. But the progressive paradigm also makes 3 big economic bets which investors should challenge. The first economic bet is that more investments will actually generate additional demand and growth. In other words, the question is whether new investment-driven policies will open up a new chapter as globalization did in the 90s. In that sense, will Biden's $2 trillion program help to bring the US back to the average growth of the 90s, which back then was at 3.2%? Will Europe's $750 billion fund help to bring the EU back to the average growth of 2% of the 90s? The hope built into those policies is that they are a game changer also for growth, at least partially. The second big economic bet is that debt markets will remain stable in the future. Can you remember the discussions during the Euro crisis when investors feared a breakup of the Eurozone and the default of countries like Greece or Italy? Well, today markets price in a default probability for Italy of merely 0.1%. It is a testimony how the ECB, the Italian government, and other actors managed to contain this crisis. Thanks God. Going forward, new policies will be financed by a lot of new debt, if markets allow for it. Finally, the third big economic bet is that inflation will stay low in the coming decade. In the last decade, the average inflation in the US was between 1.6 to 1.8%, depending on the chosen measures, and in the Eurozone, merely 1.4%. This reflects in part the secular stagnation over this period. The assumption on inflation is that it will be contained going forward. In order to deal with this structural uncertainty, we at NNIP work with unknowns. Unknowns define the key long-term questions in a chosen field like macroeconomics, sustainability, or governance, and define in detail the possible outcomes and the implications for financial markets. Unknowns are not forecasts, but an open discussion about a wide range of possible futures. Unknowns matter to investors because they help to explore and understand plausible regime shifts, to identify more robust investment strategies, and to mitigate the impact of extreme scenarios. In the context of governments, we identified 3 unknowns for the coming decade. First, nationalism versus the new left. Second, the laissez-faire state versus the strong state. And third, a multilateral world order versus a new Cold War between the US and China. How can we use these 3 unknowns to think about investment decisions? An easy way is to analyze a few plausible futures in which each unknown pans out in one way or another. Let me present to you 2 lines of thought. In the first line of thought, the progressive movement becomes the dominant political force of the 2020s. What if the US election brings about a democratic sweep in the Congress and the White House? This new era could bring higher taxes for the rich and a new wave of antitrust regulation which might harm the profitability of the tech sector. What if the European Recovery Fund gets traction? Certainly not without a series of long negotiations in Brussels, and successfully funnels investments into new green policies. In this case, the European and national investment programs could make a dent. The Netherlands, for example, might be able to reduce its carbon emissions to 50% of the 1990 levels by 2030, as promised by the government. In addition, Germany might find itself after the 2021 elections with the government including the Green Party. This could give another boost to its energy transition. What if China manages to rebalance from an investment-led to a consumption-led economy? The strategic competition between the US and China could stay contained so that it doesn't affect global growth. It would be already sufficient if China could achieve its usual growth target of 6% or slightly less. In a world where these what-ifs materialize, the key question is whether the 3 economic bets of the progressive camp actually play out. In other words, new spending and investments generate growth. The debt markets need to absorb new debt finance programs. And finally, inflation needs to stay in check. What are the investment implications of a progressive future? If the 3 big bets play out, investors might face a benign market environment. First, equity markets would do reasonably well, as long as you focus on the new growth leaders. Equity investors would mainly deal with the question whether additional demand will outweigh the shortfall from higher taxes. We are set to see sectoral shifts like from the tech leaders to companies focusing on renewable energy. Second, rates markets will stay unattractive for the time being, but at least they are stable. Credit investments would be chased in the search for yield. The risk scenario is one in which the 3 economic bets do not play out. Such a world would face a secular stagnation despite expansionary fiscal and monetary policy. The debt markets wouldn't cope with the required debt issuances. Instead, markets would require risk markups. Central banks could be too late and too reluctant in a situation when inflation rises. What are the investment implications in this risk scenario? First, investors would face a period of stress in which the two main drivers of asset returns, growth and inflation, would turn against the holders of bond and equities. In such a world, safe haven assets and investments offering relative value would be the relative winners. However, it's likely that such a political and economic environment would not be sustainable for long, and a new paradigm would follow. In a second line of thought, the status quo of a liberal economic order and a conservative, sometimes populist mindset prevails. What if Trump gets re-elected and manages to keep the majority in the Senate? In 4 more years, Trump might tick off the remaining points of the American First agenda. This could lead to a repeal of Obamacare, stagnating social welfare in the US, a deregulation of the financial sector, and the continued support for traditional industries such as oil and gas. Clearly, social tensions are set to increase in such a scenario. What if the European Recovery Fund would be watered down by conservative member states in the post-Merkel era? Most countries would focus on the creation of local champions, which have preferred access to the domestic markets and undermine the global competition. How would markets look like in such a status quo scenario? It is likely that many experiences of the past 4 years would repeat. Equity markets could initially rise further due to low taxes and fewer restrictions, before secular stagnation ultimately slows down this dynamics. In this scenario, rates are also bound to remain low. What is the risk scenario for such a status quo future? Here we need to take one step back and to look at the key economic assumption of the liberal order. The key assumption is that low taxes and laissez-faire policies ultimately pave the way for innovations and generate growth. But what happens if innovations do not occur, or they don't lead to economic growth? Then we could fall again into a circular stagnation, which would be bad news for growth-sensitive assets like stocks or commodities. Where does this all leave us? We started by understanding how the pandemic acts as a catalyst and an accelerator for the economy and the society. 3 unknowns helped us to craft possible futures: nationalism versus the new left, strong state versus laissez-faire state, the multilateral order versus a new Cold War between the US and China. By using the 3 unknowns, we have come to understand how the world would look like in a progressive era or in a status quo future. We discuss these topics with our clients. They help them to see the bigger picture and to prepare for possible regime shifts. All this, in essence, shows why we have chosen our mantra, expect the unexpected. Thank you.
Always expect the unexpected, Marco. Thank you so much for sharing your thoughts with us. I'm happy to say that we are now joined live by Mariana Mazzucato in London and by Marco here in the studio. Thanks to the both of you. Hi, Mariana, for your insightful keynotes and for being here. We're going to start with the interactive part of today's webcast. And before we do, there are actually already questions that came in even before the event went on air. So maybe let's go and try and tackle those first. Mariana, a first question is for you. Has the COVID-19 crisis changed or maybe sharpened how you think about the future challenges and the goals that you just described to us in your keynote speech?
So I think the opportunity is there. I cannot say that I see evidence quite yet that we have these major changes that we need. I mean, the first major change we need is how do we actually value what the welfare state produces, right? We only know in GDP how to value things that have prices. So we know the price of a healthcare system. We know its cost. We don't know how to measure the value when, for example, it's a free healthcare system, as some countries have. which means that we don't even know how to measure its productivity. And we constantly talk about it as a cost as opposed to a long-run investment. This is, by the way, something I'm going to be working on closely with the World Health Organization, hopefully in future months, which is how do we bring health for all at the center of how we think about economic growth. Yeah. So I don't yet see changes there, but I think this is the moment for that. But also, I think globally, we've all been clapping essential workers, key workers, but if we don't know how to value their work, it's kind of an insult, right? To be clapping someone, very good, yeah. And then we don't know how to actually measure the value they're producing.
Yeah, so momentum definitely is there, but we need to wait a little bit longer to see how that all unfolds. Another question, Marco, which came in also prior to going live for you. Someone asks, why should we already think about the future when the virus is still raging? What would be your answer to that?
Absolutely. Very valid question. We see still the virus raging. We see rising numbers here in Europe, and so I understand why people really ask why we need to have a discussion like this now. And I think this month is a good one because we see now the 75th anniversary of the United Nations. It was founded obviously in October 1945, but the preparation there went back to the year 1942, so good things take time to build, and now I think it's also the right time to think about the future. In addition, we have also hundreds of billions around the world to be invested, and we have now the very concrete decision to make in the coming years how to invest best the money, and that's the reason why we should talk about this topic.
So again, momentum, right? Marco, you obviously watched Mariana's keynote. I'm wondering, maybe you have a question for her following what you just heard. Would you like to ask her something?
Yeah, absolutely. It was a wonderful talk. Thank you very much. I enjoyed it. And from my angle, I would say I understand the new role of a state as a shaper, as an entrepreneur, as an investor. And I'm wondering, so if this is the new role, what happens to investors in the private sector, individuals? How should they invest? What is, in your thinking, the future for them?
Thank you for the question. I mean, what I argued in the entrepreneurial state was that it's not only about the future, it's also about the past, but we haven't admitted it, right? Everything that makes our iPhone smart and not stupid was actually government financed. The internet, GPS, touchscreen, and Siri. And the real question today is how can we have that kind of problem-focused investment structure, because the internet was a solution to a problem, right? The government wasn't thinking about the internet. They were thinking about how do we get the satellites to communicate, or the Navy was thinking about how to have much more precision and understanding of what's on the ground. GPS was the solution to that. So how can we do exactly what you just said before, which is to put the sustainable development goals at the center of how we think about purpose in the system, and have both public and private actors, and increasingly third sector actors, because in some areas like health and renewable energy, we do have, philanthropies doing a lot of work. How can we really do, the stakeholder value stuff, not just in corporate governance, but at the center of the partnerships between public, private, and third sector? And this is why I've been advocating now for some time, and sorry if I was a bit pedantic about it in my keynote, but anyway, that we need to bring missions, the concept of moonshots and missions, at the center of policymaking. So if government can steer, not micromanage, but steer, set the challenges, transform them into missions that are as bold as going to the moon and back again, but around our societal wicked problems, around health inequalities, around the digital divide, around climate change. And of course, play that investor first resort role. So in the areas that are still very risky and uncertain or capital intensive, but to structure their investments in such a way that really crowd in private sector investments. Crowding in is a word I don't like because it still sounds negative, but it's supposed to be opposite of crowding out, right? Crowding out is when you have a public investment which takes the place of a private investment, so crowds out, kind of think of it as elbowing, crowds out their private investment. Instead, if you have strategic, mission-oriented, long-term public investments in difficult areas, like a carbon neutral city will require all sorts of investments. If they're done strategically and in a mission-oriented way, they can then galvanize investment in all sorts of other actors. But key there is also the design of policy to be smarter. Unfortunately, we often have policies that are just about handouts, guarantees, and subsidies, which don't then create that additionality, making new investments happen in the private sector that wouldn't have happened anyway. And just lastly, I think this is actually a very positive moment for Europe, unlike in the past, where the European recoveries were conditional on austerity, right? Remember the whole kind of Greece and Varoufakis fighting the Dutch and the Germans about how to have more solidarity. The conditions at the time after the financial crisis for the European bailouts were that countries had to reduce their deficits. Today, what we have in the next generation EU recovery scheme are conditions, but not on austerity, on investment. And countries, the member states, have to come up with plans around climate and digitalization. And only if they have a convincing plan will the European recovery funds be unleashed. So this means, I really believe, this means that we have to become much more serious at the national level, but also interregionally, on what does it mean to have a plan? Unfortunately, many countries have not had plans, you know, around climate change or digitalization.
No.
So this is a positive moment.
Yeah, definitely. Marco, maybe how do you ask the question, but I wonder, how do you look at that role of investors going forward?
Absolutely, I just can echo a lot of the points that I just heard.
Yeah.
We need to crowd in investments, so, and we need to structure it in a way that there are incentives for an investor to go into those topics. And here the state has a very strong role to play in order to define the rules so that at the end such an investor from an investment point of view is attractive.
Mariana, you probably saw Marco's keynote as well. I'd like to give you the opportunity to maybe ask a question to him. Was there anything you'd like to get clarified or maybe want to know more about?
Yes, I found it fascinating, Marco, so congratulations. I've been working with the European Investment Bank around how do you bring, you know, the directionality of growth to the center of how they structure their own investments. So you might know that they're increasingly calling themselves the climate bank, and they're very much focused on the circular economy. I was just wondering, from your kind of investor hat on, what do you think the implications are literally for how we construct portfolios and the kind of risk-reward relationship as well? So when you have, say, a public bank like the EIB, which will be interacting with private finance, what do you think it means for how we not only share the risks, but also share the rewards?
Yeah, essentially that's the point. You're picking up the right one. The investments, we have public-private partnerships and we have investments that need to pay off for both sides. And I totally get your point that the state needs to be, as an investor, also take part of the benefits. But here, indeed, the investors just need to have the same thing. And if we establish a way of investing over a long horizon, I believe a lot of what we need to get done is being achieved around that one. So I think that's one of the key elements that we need to see in the future, moving away from the short-termism, moving to long-term investors. But I also believe that a lot of sectors already are designed in that way. Think about pensions, think about also some insurance contracts where we do see that there are long-term incentives to be given to those sectors. And from that angle, regulation will play its role. On the other side, you always, you know, you need to do good, and it needs to be a good investment. If you get both right, and we need to get both right, then actually you will see what sort of investments, contracts, terms and conditions will come out of this. Yeah.
I've been studying
sorry. Go ahead, Mariana.
I've been studying actually the contracts that NASA, the space agency, had for the moon landing that we're celebrating the 50th anniversary of, you know, well, last year and this year. And it's really interesting that they were very clear on what the goal was, but very open to how to get there, right? In order not to stifle the innovation process itself. And I think there's something about that also, if we think about the investments that are required actually from the patient financial institutions like the European Investment Bank, which is to really kind of, you know, steer the directionality, but the way they then crowd in private finance needs to leave quite a bit open, right, for initiative really to come from the ground. Otherwise, it will be too top down, and we know that doesn't work. You know, it didn't work for the Soviets, and it will not work for 21st century capitalism. But this issue about sharing rewards, I think it's also just something we haven't experimented on enough. You know, I often give the example of Tesla, the you know, electric car manufacturer, and Solyndra. The US government gave them both a $500 million guaranteed loan but the taxpayer in the US ended up having to bail out the failure, Solyndra, and they got nothing from the, from the successful one, Tesla. And Obama actually said to Elon Musk, if you don't pay back the loan, we get 3 million shares in your company. He should have said, if you do pay back the loan and you're successful, we as an early stage investor will get 3 million shares. And the price per share went from 9 to 90, and that multiplied by 3 million would have more than covered the Solyndra loss in the next round. And there's something about that kind of equity stakes, or if you think of the intellectual property rights, I mentioned this in my talk with the vaccines, just how to govern the process of innovation and production in order to foster more inclusive growth, as opposed to relying on the tax system. I mean, taxes, of course, are important and we can use it to redistribute, but there's something about getting the contracts and the relationships right ex ante, so you don't have to pick up the mess ex post.
Yeah, and I'm going to interrupt you right here, Mariana, because I see so many questions coming in, and I realize we only have 25 more minutes, and I want to maximize the time. So let me start off with this first question that comes in. Someone says, mission to the moon was a national US effort. Climate change, ESG, and SDGs are global issues. How can we achieve global cooperation when the leading philosophy often is competition and nationalism rather than cooperation? Marco, I'll give you the floor first. How would you react to this?
I mean, in terms of global missions, we have seen already a good example. It has been a while ago. The World Health Organization helped to eradicate smallpox in the world. They did it within a decade. It was a global mission that they set, and they achieved it. So in a sense, we need that type of spirit. And from the Paris Climate Accord, we have the first important signal. It would be good if more member states would join from that point. And so that part is a good direction. In terms of nationalism, I want to be open that in the end, every country in itself needs to understand that it's in their own interest that climate change is an issue and that we should go about it. So from that angle, I can imagine that even a very nationalistic state, as long as they see that, could implement it at the national level. But clearly, there's much to be gained from working together at an international level. And that's one of the key reasons why I pointed it out in the key speech.
How do you look at this, Mariana?
I agree with Marco, 100%. Unfortunately, we're agreeing about everything. Your viewers will be bored. It's not we should make up some area of disagreement.
We'll get to some more icky questions probably later on.
Yeah, no, but I mean, the problem is that, for example, one of the missions I talked about in my speech, I can't remember now, but I think I talked about the, cleaning up the ocean, right? So if you take SDG 13, life underwater, turn it into a very clear mission of getting the plastic out within a particular amount of time, a certain percentage of the plastic, that requires all sorts of different sectors and bottom-up innovation. But surely one country alone is not going to clean the ocean. Yeah. The water moves, the plastic moves. So how do we actually also rethink multilateralism, but from an innovation perspective, right? Not just in terms of regulation, like the WTO, or even the WHO, which of course isn't really allowed to mandate anything. They can just suggest some policies. Mm-hmm. I think we should rethink also, to go beyond that. What we actually need are things like CERN, right? CERN, a big international public lab, which by the way, got us the World Wide Web, right? It was innovation within that very large international public lab. And think about, do we actually need public labs that are international, really ambitious, also around some of our societal and wicked challenges, right? Not just the kind of, nuclear fusion kind of areas, but also things like cleaning our climate. So, a place, I mean, now with COVID, of course, we're all working from home, but hopefully one day we can go back to the office where we can mingle in the corridors. But imagine a big public lab, even in the, Amazon, for example, around biodiversity, or, even a public lab around our inequalities, our health inequalities. Yeah. And unfortunately, when we think of multilateralism and global problems, we immediately just kind of start thinking about the regulation that's required, as opposed to the production, the investment, the creativity, the dynamism, and how to foster what the World Health Organization calls collective intelligence.
Yeah. Yeah. Let's talk a bit more about value, because someone says here, totally right, value has a different meaning probably for different stakeholders. So how do you get all of the stakeholders perceiving and acting with the same value, especially in this complicated, interrelated global economy, Marco?
And here, indeed, I also, again, have to agree with Mariana in the sense that the missions statements are very important in order to align the various interests that we see. And from that angle, I would say that this is one of the ways how we can align them. In the financial sector, a lot comes down to writing contracts and defining how to share any success and any losses and risks. From that angle, that's a very technical point, and you will always have it too. But from the other side also, there are various angles how you can construct it. Yeah. And as long as the mission is the same, they will end up also working together from a right side. Yeah.
Anything you wish to add there, Mariana?
Sure. I mean, I do think there's an opportunity to become much, much more concrete with this topic of stakeholder value. I don't know, Marco, if you were also in Davos in the last couple of years, but that's all that was talked about, you know, since the Business Roundtable put that on the agenda more explicitly, but also Larry Fink the year before. That maximization of shareholder value was not getting us the kind of growth we need. We need more long-termism. We need purpose. That conversation until now has only been really about corporate governance. And so getting us things like the very important ESG metrics. I think what we're talking about here is how do you bring the notion of purpose and the common good, which, by the way, I've been speaking to Pope Francis's team about. We can talk about that later if you want. Wow. How can we bring that concept of the common good to the center of the ecosystem itself, right? So purpose and these missions we're just talking about now and stakeholder value at the center of how public and private and third sector organizations interact. But we need metrics for that. So there's no point in using words like ecosystems if we don't define it. Do we have a parasitic ecosystem between public and private, or symbiotic or mutualistic, even better? Yeah. And we don't necessarily have metrics for that. And I think it's very important because all the problems we have require partnership. But as we know with marriage, there can be bad partnerships that end in divorce or even abuse. And there can be great partnerships where both actors, you know, get healthier and are nurtured also in terms of their individual well-being. And so I do think moving forwards, you know, let's leave the Davos kind of conversations in the past for a minute, but moving forward in the post-COVID-19 recovery, given that all the different problems that are coming our way, from the need for a vaccine to stronger health system to reducing the digital divide and all the inequalities that are just getting worse, really, because the most vulnerable people are suffering the most, they all require partnership. And let's start actually asking ourselves what kind of partnerships and how to govern those partnerships for the common good. Because that hasn't been happening really in the past.
And another question for you, Mariana, that is coming in. Someone says, I find it difficult to distinguish when remuneration of an investment or charging for a service is rent or value extraction, as you say, or when it is value creation. Could you maybe give some guidelines for identifying?
Sure. So we actually have a new project that's being funded by the Omidyar Foundation. So Pierre Omidyar, one of the founders of was it eBay? I can't remember now. Oh dear. So he has a wonderful foundation that funds research projects. And the research project we have is actually going to be trying to map modern rents. So the ones that we know, you know, from the past in the financial sector and the housing sector, rents have been quite well defined. But what does it mean to talk about algorithmic rents? You know, how do we know when Google or Amazon are creating value versus when they're extracting it? And one of the things I think we need to do is get our hands dirty with some sectoral expertise and kind of deep dives into what's actually happening within, you know, say, in this case, the digital platforms. So if you think back also, especially in the early days with both Google and Amazon, they were definitely creating value in terms of allowing their whole supply chain to be much more visible on the internet, right? I mean, I know with myself, with the first book that I ever wrote, it wasn't being sold on the, you know, front windows of bookshops because I was an early author. And had I not had Amazon to sell the book, I'm sure the book would not have sold as well. No. So helping the sort of little producers be more visible. What's actually now happening is both with Amazon and Google, they're using their power, in some ways their monopoly on the platform, to really service themselves much more than their whole supply chain. So what we've been trying to do is to actually collect data on that, both in terms of advertising revenues, but also different measures that one might have as proxies for the value that's actually being created versus just kind of siphoning off, you know, the profits for themselves in excess of, this is the key point, in excess of what they have actually contributed. This notion of kind of the risk-reward trade-off, I think, is interesting. Think of venture capital as another example. Venture capitalists, of course, are very important. They often provide that high-risk finance, but it's often on the back of, as I mentioned in the keynote, public investment. So one could start asking, not so much is venture capital extracting value, but what activities or what percentage of the returns they're generating are in excess of the actual risk they took. Because you will know if you look at the sectors like biotech and nanotech or today space tech, they actually weren't there in the early stage, really high risk stage. They've tended to come in later, and yet they still, through the 2-20 model, to 2% even by doing nothing, 20% with the successes, are often, I would argue, getting in excess of the actual risk they were taking. But what is the right number? That's for all sorts of different people, including investment experts and legal experts to figure out.
Yeah, I'm going to move to the question. Next question. Someone says, as the state is seen as one of the drivers for sustaining the economy and supporting companies through the crisis, what is your view on how this debt is or should be financed, Marco?
Yeah. It is one of the key questions, key points, key uncertainties, key assumptions that I tried to bring up in the keynote speech. Indeed, that's a question. Debt sustainability is not a bad idea. We have now seen a period of austerity. We have learned from that period that at the end of the day, it doesn't help if we sort of try to focus too much on austerity to a point that the economy is prevented from growing, essentially. So the key here is that in the end of the day, we can talk about the measure of GDP, but at least there should be some measure of growth. And when we have that measure of growth, then we should try to invest into projects that are profitable for the various stakeholders and shareholders that are in that part. And to that extent, I would really say that this is the key question at the end of the day. And if we manage to do it, then growth is a good solution to many problems.
Yeah.
I understand the problems about defining growth. GDP is an imperfect measure, and I think most economists would agree on that one.
Yeah.
But in the end, you need to be productive. These ideas are still valid. We shouldn't forget about it. But at the end of the day, if there is this kind of consequence at the end, the debt sustainability will be less of an issue. The problem is when this one not works out, and then we end up with a lot of debt and little growth, and that's the problem that we have. And that could be a difficult period from here.
The next question actually taps right into that. Someone wonders, Mariana, I understand your point on the limitations of GDP, whereby all services need to be measured in money terms. Assuming that you want a commonly defined measure to aim your goals, what other metrics would you suggest instead?
Sure. Can I also just say something about the previous question? Because I think it's too important, and I will get to that one.
Okay.
So I'm from Italy. Italy has actually had a low deficit for the last 20 years. I mean, not low, but let's just say not too high, often lower than Germany's. Yeah. And yet its debt to GDP has been growing. Yeah. And even just that difference, most people have not been well informed, if you want, of the difference. So we often, talk about the debt and the deficit as though they were the same thing. But with debt to GDP, which does matter, because if it just goes completely out of hand, you won't be able to pay it back. What is important is exactly what Marco was talking about, which is we need to worry more about the denominator. As long as you're investing and increasing perhaps your deficit in the short run, and all the key drivers of long-term growth, so research and development, human capital formation, training for workers so they can actually transition to a new economy, a greener economy, a more digitalized economy, that will foster a higher productivity growth and higher GDP in the long run. But just focusing about the numerator, the growth of the deficit, so the growth of the debt, so the annual growth of the deficit, that has caused so many misplaced policies, which have ironically reduced deficits but increased debt to GDP. And this whole moment that I was talking about before, this European moment, which is really an inspirational one in many ways, because the recovery funds are dependent on strategies around long-term plans around both climate and digitalization, hopefully will have changed the narrative in Europe. On the question around GDP, I think we need to resist coming up with one measure. We need to think of a dashboard, and I know that's often said, but you would never drive a car and expect to just know one piece of information, your speed, or just how much gas you have. There's all sorts of things, right, that are telling you how well you're driving and how fit your car is, does it need to be repaired. And I think, again, coming back to the Sustainable Development Goals, being sure that we transform them to be core parts of that dashboard are absolutely essential. But also institutionally, so all these different types of public institutions, including a public bank, which we discussed before, the last thing you want is for a public bank just to hand out money to sectors that are in trouble, right? What you actually want is the way that we structure loans or grants, or say procurement policy, but just sticking to a minute with public banks, is to make their own loans conditional on that kind of transformation that get us closer to an SDG goal. And so this was interesting. I found recently with Germany, the KfW lent money to the steel sector, which is kind of an old clunky sector, only if the steel industry was willing to reduce its material content, which they did through repurpose, reuse, and recycle. But it's very hard for each organization just to make up things as they go along. That's why we need metrics and global and macro metrics that help organizations actually move and be more aligned, so we get policies that are actually more systemic. And that's why the whole replacement of this one number in GDP by something more wholesome is so important. Having said that, GDP is actually quite useful in telling us how sick our system is. In the UK, where I'm standing now, we are growing not through investment-led growth, but consumption-led growth that is fueled by private debt. So the debt to GDP ratio is back to what it was just before, the private debt to GDP ratio, private debt to disposable income, back to what it was just before the financial crisis. And that caused the financial crisis. I can tell you that's not in any newspaper I've seen, and it should be.
It should be.
That you can see, those numbers I just mentioned, you can see with GDP as it's classically measured. So the real point is use GDP for what it's useful for and not for what it's not useful for.
But do not focus only on that.
Exactly.
I'm going to move in to the next question. Marco, this one's for you. Someone says it's great that we talk about these long-term and far-ranging transformation, but I'm wondering, as someone in the business of building up wealth to fund other people's futures, if reinvestment should be favored over value extraction. How would you see that altering, or should I approach this? For example, does it tilt towards more specific asset classes or more specific strategies in your view, Marco?
We discussed a lot of long-term problems. For those, we need long-term solutions and most likely also investment opportunities that match those points. We also now have an election around the corner, which will have an impact on a lot of policies that we will see in the coming years. So the strategies that we will see at the moment is one where we have the challenge of finding a solution to the uncertainty that we have at the moment. And as this one disappears, we can direct our investments step by step into the direction in which this one is going. We see, for example, a surgence of green bonds. We see ESG products coming up. So from that angle, we see a lot of these products that go into that direction, have already exposure in the right areas, also with a view on long-term decisions. So that's already something that we also be doing and out of conviction. And where we stand at the moment, where the shorter term investments, there you will have to deal with the uncertainty. And the problem is then, of course, that you're going through various waves. So for shorter term investments, you need to ride those. But if you have a conviction in the long term and those investments really help directing the money in the right direction, then you have an alternative to that.
Thank you. Mariana, another question for you. This person says the European Commission has launched a call for contribution on competition policy to support the Green Deal and delivery on its long-term climate objectives. We just spoke about that. Do you see, Mariana, this effort to steer EU competition policy towards Green Deal objectives as an example of embedding missions in policy making?
Great question. So my work with the Commission originally with this approach, which I called mission-oriented policymaking, began in the DG, at the time it was called RTD, so basically research and innovation. And through that, it was actually voted on by both the European Parliament and the Council to bring this missions instrument to the table. So it's now actually a legal instrument that is being used in Europe to redirect the challenge-oriented policies in a more mission-oriented way. And what I then argued was that we needed to bring that up one notch to the cabinet, right? So that von der Leyen, with her goal of really bringing the Green Deal to the center, this is pre-COVID, of the European growth trajectory, and now post-COVID or during COVID in terms of its recovery, required missions to go to that higher level and to really work across the DGs. And I think we still need to see if that's going to happen. I mean, this is my provocation to the European Commission, which of course I work very closely with, and I believe very much in its work. But I don't yet see the concept of missions as being a way to really foster interdepartmental working. Unfortunately, as happens also at the member state level, it happens with any government, you have sometimes these departmental silos. So each ministry or department will want to have its own kind of plan. But if you put, for example, any mission that has to do with well-being just in the Department of Health, it's not going to work, right? We also have to think of what's the role of the Department of Transport or those that are thinking about nutrition. And this is why I think it's really interesting to look at how some countries like Sweden have thought about missions at the center of, for example, the welfare state. So they have the mission of having a fossil-free welfare state, and they do so by then looking at all the different public services, including school meals. So school meals, the food that's delivered in our public school system is very important. In many countries, it's the only proper meal that kids get, which means it's very dangerous during a lockdown COVID period where kids are not getting their free school meals. But anyway, making school meals healthy, tasty, and completely sustainable is very important, right? So you can think of the production, the distribution, and the consumption of something as concrete as a school meal to become the focusing device. But you can just imagine the 20 different sectors that would have to work together. So it wouldn't just seen as even within one government department or one industry in the private sector, but that true kind of collaborative model. And I think that's what we need to be striving for. So any green mission and any Green Deal mission, by definition, will require changes in transport, nutrition, textiles, construction materials, renewable energy. But that really requires bringing those missions at that higher level, at the macroeconomic level, really.
I cannot believe how quickly this 1.5 hours is flying by. I have to already wrap it up to the last question. This is going to be a bit of a challenge maybe for both of you, but we heard so much and we got so much information that my question to both of you would be if you could summarize and try to keep it short, maybe just one sentence, could summarize what is the key takeaway that people who listened in today should remember from this session. What would that be? Mariana, I'm going to hand to you first.
One sentence. Wow.
Yes.
So there is, okay, I'm going to try to put some commas in the sentence. There is no problem that will be solved by the state alone or business alone. What we absolutely require is a new form of partnership, a dynamic mission-oriented partnership that puts purpose and stakeholder value at the center of how we work together.
Thank you. That was one sentence. Perfect. Marco, what would be your summary?
Also for me, the challenge of one sentence, I think it would be really that this COVID crisis is acted as an accelerator, as a catalyst, and investors really need to prepare that there might be potential fundamental shifts in a political space in the way how we invest, and they need to watch out and need to prepare to the extent that's possible at every stage.
Yeah. Be ready to expect the unexpected. Excellent. Okay, thank you so much. I thought this was very interesting, and I loved having both of you here and for this thought-provoking session. Thanks to the both of you. It was a great pleasure and an honor. And thank you, our audience, for watching us. We started this Upside Down series back in June, not really knowing where the pandemic would take us and how things would unfold. And now here we are, it's late October, and it looks like all of this is going to last a little while longer. Of course, it's very difficult to predict what exactly will be coming our way. The first big unknown are probably the US elections next week on November 3rd. Late November, NNI Investment Partners will be reaching out to you to share their first thoughts on what's coming next. And they are definitely very keen to stay in touch with you over the next months, beginning with an email with today's link, so you can rewatch it or you can share it with people that will be coming your way in the coming days. For now, stay tuned if you want to be part of the networking session from here in the studio, from Marco, and I'm sure also from Mariana over in London. We would like to thank you very much for joining us. We wish you a wonderful rest of your week. Thank you for watching. Bye-bye.